Hello, this is Rich Vessel, founder of Advanced Projections, here with the Advanced Projections Economic Report for May of 2023. The review of the highlights for April and May are the following. Employment figures for April came in with another solid new jobs figure up 253,000, and unemployment moved back down slightly to 3.4%. We still expect that unemployment should eventually begin to gradually move upwards because at these low levels the Fed must stay fully focused on inflation, given this as continuing ammunition for further rate increases. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. Annual CPI inflation through April was announced on May 12th, with consensus expectations for it to be around 5.0%, and the actual reported value was 4.9%. However, sticky price inflation, less food and energy, continued high in April at 6.3%. Almost 1.5% higher than the more general CPI number. A declining producer price index for all commodities also continues to signal a likely recession, and we have a graph in our written report that illustrates this point. The Federal Reserve added another 25 basis point rate increase to their Fed funds rate on May 3rd, bringing their range to 5.0 to 5.25%. We had expected them to implement this increase, and new inflation and employment numbers may make them go there again in mid-June, or certainly at the end of July. In mid-June, they will issue a new set of projections for 2023 through 2025, and we're still looking for a longer fight against inflation with higher rates than they have recently projected. The continuing hot employment picture is likely to confirm that scenario. Their March projections and dot plot was proclaimed to be effectively unchanged from the one before that, but close examination showed that the most hawkish FOMC members had increased their hawkishness, and that translates into continuing expectations for higher rates. Another dot plot comes out in about a month. Equities markets have gained as much as 15% since the October 2022 lows were put in, but recently have hovered around key resistance levels. The S&P 500 has tested overhead resistance around 4,200, where it is above its 200-day moving average. The bond markets revealed that smart money is still paying more attention to the Fed signals and pronouncements, which were reflected in the S&P 500 gaining only 60 points during April, and recoveries from banking issues which have so far been handled expeditiously. Everyone expects Congress to not crash the quality of U.S. debt instruments by playing chicken with the debt ceiling. We expect so too, but this is an added complication for the Fed and perhaps for the economy as well. The drop-dead date is purportedly June 1st, but what games might be played up to that point and perhaps for months afterwards is anyone's guess. There are now no AP indicators showing green, and only one, the AP Stock Index indicator, that continues to skirt the boundary between red and yellow. Now here are the current underlying economic details. In early February of 2022, advanced projections gave an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program that April. Here in May of 2023, there is continuing evidence of ongoing moves to cash as reflected in the money market deposits and the long-term bond market. People are realizing the resolve of the Fed in their long game battle against the inflation dragon. The recent bond trends reflect many more Treasury instrument purchases at the longer end of the yield curve, which has continued to accelerate the 3-month versus 10-year yield spread. This remains a clear indication of a significant flight to safety as long-term investors continue seeking to capture high long-term bond rates. 30-day Treasury yields have vacillated wildly over the past several weeks as concerns about the debt limit brinksmanship concern the buyers of those instruments. Year-over-year consumer price index increases and tight labor markets continue to affect many aspects of the economy. General expectations out just ahead of this April CPI announcement were for 5%, and those numbers came in just below that at 4.9%. The Federal Reserve will not be swayed much by that number, as the underlying sticky inflation numbers are not coming down as rapidly. Employment has not yet turned to a negative trend, and consumers are still spending record amounts on credit. Bureau of Labor Statistics reports that unemployment continues to remain well below 4% over the past 11 months, now at 3.4%, with new job gains in April of 253,000. We had expected those gains to dwindle in the first few months of this year, but there is still no evidence of it yet. We now expect to see a more significant trend of layoffs begin sometime in the summer of 2023. Below in the report is a table showing the employment situation as reported by the BLS. All employment numbers are still up, including labor force participation rate and total numbers of employed persons. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so right along with their 11 rate increases in the March 22 through May 23 timeframe, and within their last available FOMC meeting minutes. Look for continued small increases when the Fed FOMC returns with its next steps at the beginning of summer. Their recent rate increases came in 25 basis points below our expectations, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part here in the middle of 2023. Expect at least one 25-point bump this summer, most likely in June, and perhaps as much as 50 points if they lend more weight to the still climbing credit debt, employment, and sticky inflation values. Below in the report is a quarterly table that was issued in the Fed's March report, showing exactly what to expect, why to expect continuing Fed hawkishness. Note that all their projections made last December have been updated in March to show somewhat higher interest rates and longer lasting inflation than they previously thought. This kind of uprating has been the case every single quarter since their fourth quarter of 2021 report. Higher rates for longer means more braking on the economy, and they indicate they expect more than a full percent higher unemployment from the current 3.4% as a long-term consequence for 2023 through 2025. Very tepid GDP growth was anticipated in that chart as well, but the Fed has now publicly stated they expect the U.S. to enter recession later this year. A new set of Fed projections and dot plot will be issued after the June FOMC meeting. On the energy front, global interest rate increases in 2022 and 2023 had already had a significant effect on the price of oil, driving it down more than 40% from $123 a barrel in June of 2022 to around $75 a barrel recently. This was in spite of OPEC and Russia cooperating in an agreement, both financially and politically motivated, to restore their 2020 through 2022 2 million barrel per day production cuts to levels which were in force during and through the first quarter of 2022. At the beginning of this April, OPEC and Russia agreed to an additional 1.2 million barrels per day in production cuts to support prices for their oil. The markets responded by moving oil up over $80 a barrel again, but that lasted for only 2 weeks. Then oil collapsed by 17% to below $70, rebounding a bit back to the low 70s where it sits now. We'll keep an eye on global demand forecasts to see where oil may go over the next several months, but our expected volatile range for the next several months is $65 to $80 a barrel. Gasoline prices only pushed north of $4 a gallon in a few regions this spring, as a higher than usual number of refineries entered maintenance shutdown periods, but have been generally moderated by declining crude prices. So the probability of high gasoline prices for the summer has been moderated. If traders depress oil prices further, we could expect to see average pricing move nearer to $3 than to $4. Natural gas prices may be ending their pricing breather now that the Freeport, Texas LNG export facility has now fully returned to service. A warmer than predicted heating season had depressed demand somewhat, and underground storage of natural gas was used the least since the mild winter of 2014. Overall, U.S. natural gas consumption fell to lows last seen in February of 2018. Now that the Freeport facility has returned to full production, LNG export activity should be back to near maximum, consuming the equivalent of the entire production volume of the Haynesville Shale area, one of the nation's largest production fields, significantly representing 14% of our total domestic demand. There is a lot of yin and yang in the market forces that determine natural gas prices, but for now they have generally declined significantly from high levels seen at the end of last summer. That should also relieve electric power production costs, as natural gas accounts for about 40% of the U.S. generation mix. The Energy Information Agency had issued their own projections for declining gas and electricity prices in the near future, but we are going to take a wait-and-see attitude before declaring high energy prices to be completely behind us. Their recent energy outlook reveals a new position that natural gas is likely to have bottomed and will increase slightly looking forward over the next 6 months. In equities, fresh news in the form of those 253,000 new jobs and a modest Fed rate bump brought some life back into equities. The expected several bank failures and identified weaker bank situations, such as Republic Bank, have added little to overall market weaknesses. Quick confidence-boosting actions rescued the situation, and those seem to have prevented an emotionally driven bank panic. These events are likely to not temper the Fed's actions to quell inflation, however. We continue to expect a few more interest rate increases and then further general declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3000. However, if the S&P 500 pushes above 4250 in the next month or two, it would be returning to exceptionally high-risk territory. As the Fed still appears to be highly resolute in their attack on inflation, that means some significant rate hikes should still be expected, beginning with the next one about 3 weeks after the release of this report. They have clearly stated what their targets are, that inflation has not fully responded as needed, and they are dead set against pausing or quitting their program too early so as to avoid the mistakes last made in the 1970s. In the written report, we have a longer-term chart with actual analyst projected values for S&P 500 earnings and revenue growth from 2017 through 2023. Our markup shows where we think they have miscalculated similarly to what we did for the middle of 2022. The first test for the analysts will be when final fourth quarter 2022 earnings come in. If they continue to miss expectations en masse, it becomes more certain that 2023 will be weaker than currently expected. However, analysts are likely to understate negative expectations, but even so, they are reducing earnings expectations for the first quarter and second quarter, with a current projected year-over-year decline of nearly 7% for the first quarter of 2023. Also, analysts' second quarter levels of buy recommendations are well below average and sell recommendations well above average. The majority of reporting companies have provided negative second quarter guidance, but to a lesser degree than earlier in the reporting period. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric, which appear ahead of real economic downturns. The March number for this metric was up a bit by 3.4%, but it fell again in April by minus 2.1%. Equity traders are mistakenly thinking the Fed may be done with its program of rate increases, but as indicated by our markup in the February chart in the report, risk capital has clearly made some serious exits from the markets, down 19% for this margin borrowing figure. An equity market bottom may be near on a historical basis when margin borrowing declines a full 50 to 55% from its previous high. So there is still the potential for a further decline of around $350 billion to realize the full decline from the last high of $1.02 trillion. Our markups show the margin borrowing declines that appeared ahead of the last two recessions and associated market collapses. We'll create an updated version of this chart with fresh numbers that will come out for the month of April. This is a month behind when it comes out. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.